Hi, Investor Nation and Tasty Nation. Today I'm going to talk about trading the US Treasuries. Now, there's multiple ways to trade US Treasuries, and one is to trade the yield curve, and another name for yield is just interest rates. But I'll talk about the yield curve in a separate video. Today I'm going to talk only about selling premium in the Treasury products, specifically /ZN, which is the 10-year Treasury note. I submitted this trade to Liz and Jenny last week, which was just selling a simple iron condor in /ZN.
Okay, yeah, I'm going to pop into Twitter. One of our favorite guys coming in. Here's Stefan, Dr. Zayas. So good to see you, Stefan. I hope you are well. Let's see what he's writing in about.
Did you get out of the ZN already? Because let's pop into this with Dr. Zayas.
Yeah, with IVR elevated in ZN, I'm looking to sell a Dr. Z style iron condor in October. So selling the 131 put, 135 and a half call, and then he gives his long wings here. Credit around 300, max loss 2,200, pop around 75.
I like it. Let's take a look at it.
I like it, but with our long 10-year.
Well, I mean, this is just like selling a strangle around it. That's what I think actually, it's kind of like what we do with other products. We'll sell a strangle around long stock. That's exactly what we did.
Maybe we skew it a little bit where we have a wider put spread and a narrower call spread.
Yeah. And I mean, these are wonky. So just go to the expected move and just kind of run with it.
So you can this came in 14 hours, selling the 131 put, 135 and a half call. 135 and a half call. Yeah, right. And so that call spread, I want to see like how wide we make these, how much the risk is. Okay, so here, 29 to 31.
You have 35 and you have 38. You got to make it symmetrical to see the risk.
There we go, 1,700. So this is symmetrical.
35 and 37 is 2, and 129 to 131. Okay.
Yeah, 2 and 2, just like Chuck Willery, 2 and 2.
And Jenny, you can see the 2. So the 2 is actually 2,000.
Yeah, 2,000, right? Because our max loss is 1719. We're taking a 281. So this is like a $20 wide spread.
Yes.
So if we maybe move the calls a little bit and narrowed the calls, so that's just like $1,000 in risk on the call side.
I mean, you could even move it up one.
I know they're all almost the same.
Yeah, let's ship this.
Okay, so we've got a $15 wide put spread, $10 wide call spread. We're taking a $1.88.
And I like the buying power effect. It's only $2.99, but I like looking at the max loss on it as well.
We're still working the other one, but thank you very much, Dr. Z, for sending the iron condor in ZN.
Okay, so Liz and Jenny did their own version of that trade, and that was a really good example of how you can always tweak these trades to make them your own, to make them more in line with what you're comfortable with in terms of the max loss and the credit you're going to receive. Let's pop over into my trading platform and I'll show you what I did. Okay, so this is my IB trading platform. I've got the US Treasuries here on my favorites list, and I've got the small exchange products down here. So here I've got ZB, which is the 30-year Treasury bond, ZN, which is the 10-year US Treasury note. Also, we just call that one notes. Then there's ZF, which is the 5-year Treasuries, and ZT, which is the 2-year Treasuries. Down here, we got the small exchange product. So this is the inverse of the Treasury products. This is the 2-year yield. This is the 10-year yield. And this one is the 30-year yield. There's no options yet on the small exchange product. So for today's video, I'm going to focus on ZN. I'll unclick the weeklies and quarterlies, just looking at the monthlies. And if I go to the 46 days to expiration, you can see the trade that I already have on. I'm short the 131 put and the 135.5 call, and I'm long the wings 2.5 points wide. So 2.5 points in this product, the multiplier is 1,000. So that's 2,500 is my max loss on the put side, and 2,500 is my max loss on the call side as well. So my effective max loss is 2,500 minus the credit I received. So if I was to duplicate this trade now, I'll turn on my strategy builder, sell the 131 put. I'll just expand this window here, sell the 135.5 call. You can see the margin impact on selling that strangle would be 2,900. And that would be a perfectly reasonable trade for my size account. You would actually save a little bit on commissions if you just stuck with the strangle. In this particular case, I chose to define my risk on the trade. So with the max loss of 2,500, so I bought the wings 2.5 points wide, and that reduced my buying power usage way down to $819. So that's one of the reasons I like to define my risk on futures products, which is to reduce my buying power usage. And also I don't have to worry about buying power expansion in case the volatility really picked up in this product. And as I got closer to expiration, the buying power could expand. But either way, selling a naked strangle or an iron condor, I would say would be pretty similar with the outcome you're going to have. So now for the actual tick sizes of this product, this might be a little confusing to some people. These options are trading in 64ths. The actual ZN Treasury notes trade in 30 seconds, but these options trade in 64ths. For example, if I choose 15/64ths as my credit I want to get, if I pull up my calculator here, 15 divided by 64 is 0.234. So the multiplier there is 1,000. So times 1,000, that would give me a credit of $234. And if I just click on the margin performance here, it'll show, yeah, that's $234 that I'm collecting there. The commissions are variable in IB, so under $10 for 4 legs, which is not bad. It's a little bit more expensive trading futures than regular equity options. The buying power, like we said, is very low. This is the Iron Condor risk profile that I'm showing here. So I want the notes product to stay between 128.5 and 138.1 over the next 46 days. And if you haven't seen my Tasty Trade Mechanics video, make sure you check that out. I'm probably not going to hold this the full 46 days. I'm probably going to aim for about half that and aim to do something around 21 days to expiration. So here, my probability of profit here is 80%. That's a great pop. My max loss is 2,300 and I'm only collecting $234. So I could actually go a little bit higher than that and trade off a little bit of probability of profit to get a bigger credit. So that's entirely your preference. There's no better or worse way to trade this. I'll go ahead and transmit that. And if I was to show a different example here, so if I wanted to be a bit more aggressive and go a little bit closer to the money, I could say sell the 132.5 put and the 134.5 call. The market's not open right now, so that's why it's not populating these values here. But anyway, the mid price here would be around 47/64ths. Margin impact is 3,000 because this is just a naked strangle. I didn't buy the wings yet on this. And if I go to my margin performance, that works out to a whopping $734 credit, but my probability of profit is reduced down to 63%. So that's the trade-off you make with collecting a bigger credit and having a smaller probability of profit. So there's different ways of selling premium in the treasuries. One is selling a strangle, selling an iron condor. You could sell just a put spread or just a call spread, depending on if you're bearish or bullish on the treasury notes. And remember, the notes are inverse to the yields. So if you think interest rates are going to go up, then that means notes are going to go down and you would want to be bearish on notes. But if you think interest rates are going to go down, then you would be bullish on notes and you would bet for notes to go up over time. Even when we have these biases, we're not necessarily going to be correct on the exact timing on them. So this is why we just want to trade strategically and not worry too much about our directional bias. So that was a good example of selling premium in a US Treasury product. Keep an eye out for my future video where I'll talk about trading the yield curve. Thanks for watching.